Welcome back to the Always Thinking Mindset channel, where we give you positive vibes and simple rules to overcome your goals. In today's episode, we're going to speak on three types of loans every real estate investor needs to know, whether you're starting off or whether you've been in the game for a while. You have to come to this agreement to understand what the document and paperwork say. Now, before we begin, if you like today's episodes, please give it a thumbs up. It does help the algorithm. If you don't subscribe, that's fine. Just please give it a thumbs up. And if you love the channel, go ahead and subscribe. Now, before we begin, I want to give a disclaimer that I am not a legal expert. I am not professional. Please seek out your own guidance and your own advisor concerning any loans, any kind of real estate transactions. And let's go ahead and get today started. All right. So, in the first loan that we need to know about, it's called the VA loan. What is the VA loan? Is Department of Veteran Affairs. Usually it's a government-backed loan, and it focuses mostly on military branches, right? Anybody who's served in the military. The federal government has created this program to instill the service members to purchase a home. Now, the pro with the VA loans is what everybody wants, right? Zero down payment. What does this mean? This means you keep more of your money in your pocket for repairs, closing costs, whatever the case might be. 0% down is wonderful, especially if you're going into real estate investment portfolio you're trying to build. This is a good loan to start off in the real estate game. Another pro is that usually there's no PMI attached. What is PMI? It's the principal mortgage interest amount. Usually it's the lender's insurance against you. So in case you can't pay the mortgage or the loan, they have pretty much attached an insurance policy to it. Now you're still paying for that. So they're taking out insurance on yourself. That's what PMI stands for. Now, with the VA loans, you also have what's called, lower interest rate. This is actually good. So when you purchase your home, that's what you want. Lower interest rates means less money, less mortgage payment. But in the end, you have to kind of focus on you and what do you really want. Now, the cons with VA is that you can only use it on your primary residence, right? So if you have any other properties and you want to make a secondary investment or second home, then more than likely you're not going to qualify for that. But that's okay because VA loans are still strong. And if you know how to navigate the seas with the VA loan, then you're better off than majority of people out there. Now, the second loan that we're going to get into is called a conventional loan. This is your most traditional loan when it comes not backed by the government. But the pros with that is that it can be as low as 3%. The standard is 20% down of the home, right? But if your credit score, there's several other factors involved that can lower the interest rate. I believe 5% down is usually the good case of someone with good credits, other factors, W-2, strong income. But the conventional loan is a great loan to actually put into the seller's hands because what happens is, once when there's a seller selling their house, they're looking at what kind of loan you qualify, and this can affect whether you get the property or not. This is why I made the video because you got to understand the differences between these loans, the advantages and disadvantages. Now, the other pro is usually there's no PMI attached as well. What this is the same thing, principal mortgage insurance. What it is the lender taking an insurance policy out on you in case you default on your loan, saying that even if you don't make those payments, then they have a policy attached to help you pay or to get the money out of the property in itself. Now, the thing is, with conventional loans, they can be investment loans, usually on a second home or what's called a rental or investment property. It can be used for that, and that's what you want, right? Especially when you're trying to build your portfolio. For all you youngins out there that just started off in the 20s, this is something that you're going to run across through in the lifetime of your real estate uh, development. Now, the cons with conventional loans, usually the credit score is higher, right? So somebody who's never been exposed or has high credit, the lender or the banks don't tend to go towards that because they don't trust you. You don't have enough credit. Now, with that being said, doesn't mean you can't qualify. What it is that the higher your credit score, the lower the interest rate's going to be. So it's the same thing backwards, that if the lower the credit score, they're going to give you a higher interest rate. They're going to make their money, right? But you got to understand the pitfalls, the good and the bad from that. And another con is that usually they have tough credit guidelines, right? They're going to want W-2s. If you have any other investments or property, you got to come at them really good in a comfortable way to where they can lend you that money in the conventional loan. Which brings me to my last one, which is FHA, Federal Housing Administration. It's another government backed loan. This is the most common out of all three. This is the one that usually everyone has or qualifies, can qualify, depending on factors, depending on where you come from. But I will tell you, this is the most common. Everyone usually has when they make the offer. Now, with FHAs, the pro is that you come in at 3.5% down payment. And that is pretty cheap because to me, what happens is whenever you buy a property, you kind of want to save all the money that you have because that is your investment money. Or for any repairs, closing costs, there's a lot of fees attached to whenever you close on a house. So the lower the down payment, it's actually beneficial for you because you get to keep that money and do whatever you need to do with it. But the thing is, you are coming in at a lower interest rate. So at the same time, banks, they do want either a 15 or 30-year fixed rate. But that's one of the benefits of having the FHA loan, which everyone usually qualifies for. But and also one of the main pros is that you can have a low credit score, right? Because it's not as high as a conventional loan. It's a government-backed loan. The federal government wants everyone to purchase a house and tries to make it as easy as possible. Now, with the cons of FHA, it's usually a PMI attached to it. Same thing, principal mortgage insurance, and you pay for that PMI. So basically, what happens is the lender looks at it and says, yeah, okay, that's fine. We'll give you the loan, but you're going to hold PMI. And usually that can range anywhere from $100 to $200, depending on the loan, how much the quantity is. But what it is, it attaches to your mortgage payment, right? So you're paying for their insurance policy on you, and it's not contributing to the principal of the house, which if you round that up within 15, whatever fixed rate you do, 15-year loan or 30-year loan, that tends to add up. And it's usually the duration of the loan, okay? So that's what happens when it's FHA. Like I said, that's more of a con, especially a major investor that's been in the game a while. They don't want anything attached to it. But also, it is a federal government loan, so they're going to have a lot of red tape, a lot of requirements, and the main things that whenever you purchase a home, some sellers don't want to deal with red tape, especially their appraisers and people coming back and saying fix this, fix this, fix this in order to qualify for the loan. So FHA is the most common, but not preferred because at the same time, sellers, they just want their money. They want you to purchase their property, cash your check, and get out. But with FHA, it's not a bad deal if you can make it work for you. I know plenty of investors still doing the FHA program, but those are pretty much your three types of loans that you need to understand as a future real estate investor or a real estate investor. Now, everything is subject to change. There's plenty of factors involved, so please do your research. Please understand the terms of the agreement before you step in. Like they always say, this is the biggest purchase of your life. But in order to step in the game, you got to get used to the terms. You got to understand the financing aspect. And these are the three most common loans whenever you step into real estate on your real estate journey. Now, there is one more which I kind of left out, but if you have cash, then you're king, right? That's the saying. If you have cash, you're king. Um, some people just by the stroke of a pen, are able to purchase the property, but even with this listing price. The thing is, that's usually a high-end investor, somebody that comes with money and is not worried about money. I didn't include it in this video because majority of people that's starting out in real estate game usually go through those three, uh, loan types. But in the end, I just want to get on the side note. The reason I say these loans are very important because I just recently closed on a property. Um, I was the lowest, but I had a conventional loan, right? We had two other offers on the property, and they were both FHA. And let me explain to you the difference. So the other ones came in, I believe, 10 grand over, but at the same time, they were asking for concessions, which is usually, help with assistance in closing costs, stuff like that. So the seller wasn't really interested in that. Um, the second offer did come in a little higher, same thing, FHA. Mine came in at the lowest, which is the most reasonable and fair offer, but I had a stronger presentation. I attached a pre-qual letter. We did delivered comps on the property, right? Because we're not just speaking out of thin air. But just understand the loan types because sometimes sellers don't want to deal with the pain of government or bureaucracy, and they just conventional is straight money from the lender or it's just less requirements. So if you had to put a hierarchy on it, it's usually whether it's conventional and then FHA at the bottom. Like I said, there's a lot of red tape when it comes to government loans, government entities. So your best bet is usually going the conventional route. If you have cash, great for you. Congratulations, you can purchase it on the house. But these are the most common three types of loans that you need to do or study on your real estate journey. Like I said, there's plenty of books, materials out there. So please get knowledgeable about this because this can not only save you thousands, hundreds of thousands throughout your lifetime, right? Because you're dedicating your life 30 years, 15 years, whatever the term of the agreement is. Not to say you can always refinance later, but this can affect anything from your APR, your interest rates, whether you get the property or not. And I just wanted to explain in this video that these are the most three types of common loans that usually investors see. So if you like today's episode, give it a thumbs up. Thank you for watching this video. I hope you joined the channel. I also have a podcast, so please check out the other podcasts, check out the other videos as well, and we shall talk soon, okay?